Diversification is for idiots. That is true, my friends. Diversification is for idiots, but there's caveat. I'm going to throw in there. If you're trying to beat the market, all right? If you're trying to beat the market, diversification is idiotic. That's all there is to it. Look, the only way to beat the market is to be concentrated. You have a small portfolio, you're taking heavy bets on one thing or two things or five things, but not on 500 things. You're basically saying, I believe this sector or these 3 or 4 stocks are going to explode in a good way, and as such, I'm concentrated. And if you are right, you will beat the market. If you are wrong, you're going to get crushed by the market. That's all there is to it. All right, so we have lots of data on this, man. It's not even debatable, frankly. We have lots of data of what is called closet indexing and how evil and bad these people are for investment portfolios. And we have lots of data on concentrated portfolios. And so let me tell you what happens here. A closet index is a fund that is basically mimicking the S&P 500 to pretty significant, like 80%. Was it beta, not beta, whatever the R square, I can't remember, the R squared, I forgot all the terminology on that. It frankly doesn't matter. But basically, if the S&P 500 has 500 stocks, a closet index will have like 350, 400 stocks. Except the closet index doesn't charge 5 basis points like an S&P 500 index does. It charges 1.15%, so 115 basis points. So they have such a high correlation, 85, even 90% correlation, and yet they're charging, freaking 50 times the fee. It's impossible for them to beat the S&P 500 because the fee's too high to justify how close they are in correlation to the S&P 500. So they're never going to beat the market. There will always be less than the market, essentially by the fees that they charge. That's all there is to it. It's simple mathematics. Now, on the other hand, if you had a concentrated portfolio, let's just say you only had 5 stocks, or 6, I guess we'll say. You had Tesla, Amazon, Apple, Google, and whatever the other one is. I'm not sure, Microsoft, something like that. But anyway, you have 5 or 6 stocks. I guarantee you've smoked the S&P 500, i.e. you've smoked the market. There's no two ways around that because your concentrated portfolio happened to rise significantly higher than the S&P 500 as a whole. So you've smoked the market with your concentrated portfolio. The question is, what happens when that concentrated portfolio turns on you? Will you have got out in time, all right, to continue to smoke the market? Because at some point, that concentrated portfolio will turn and you're going to get crunched. The only way you can avoid that is by selling before that happens. And if you do sell before it happens, then what are you going to do? Are you going to put your money in another concentrated portfolio of airline industries, Carnival Cruise? I don't know. That's the issue. Diversification always means you have to say you're sorry. That's what it means. You're always going to have to say you're sorry with a diversified portfolio. I own, let's see. In February, I owned a small portion of Carnival Cruise Lines. I don't, but let's just say you did. And you're like, man, why would I have Carnival Cruise Lines? It got hammered during the initial lockdown. Well, in April, you're like, man, why didn't I own Carnival Cruise Lines? Because it just went up like a bat out of hell after the March 23rd bottom. You see what I'm saying? Diversification means you're always going to have to say, I'm sorry, I either had too much of a stock that has gone pummeled or I didn't have enough of a stock that got pummeled. Either way, you're like, damn, I wish I would have had more, or I wish I would have had less. That's diversification. Concentration means I am taking a gamble on this stock or this field or this industry, whatever, or these group of stocks, whatever it is. There's something called active share. I haven't seen that as much lately, but back 10 years or so ago, a couple guys and a couple more guys and a couple more guys had written some stuff on active share as a way to consistently as the only way to consistently beat the market. And it's true. Basically saying a non-correlated portfolio, and I think they said you want an active share of 80% or more. What an active share means, you got S&P 500 has 500 stocks. If you have a fund that has 400 stocks, that's in the S&P 500, you have a highly correlated portfolio, so your active share is 20%. And what that means is you have 80% similarity to the S&P 500, which means you have 20% dissimilarity, I hope that makes sense. So an active share of only 20% is a closet indexer, and it's impossible for that to beat the market when you factor in fees. It's just not going to happen. All right, now if you have an active share of 80% or higher, that means you have 100 stocks where the S&P 500 has 500. So you have a 20% correlation to the S&P 500. Thus, your active share is 80%. You're essentially taking an active bet on 80% of your portfolio relative to the S&P 500, and it's much more probable that you can beat the S&P 500 with an active share. Of course, it's also much more probable you'll go way off the reservation and get smoked too. But the drawback about that isn't that we want closet indexing, because closet indexing, again, a low active share of 20% ensures that you're going to lose to the market each and every year because of the matter of the fees. It's just there's no getting around that. So if you're trying to beat the market, you want a high active share. That's a fact. You want a concentrated portfolio, all right? But that's not investing. That's speculating. You're speculating on these industries, these stocks, whatever it is. That's not investing. You're saying, you can make a case it's investing if you're going to stay for the long run, but if your whole point is to beat the market, that's speculating. Don't do that. Don't do that. If you're investing, that means you're sitting for the long term. You say, I truly believe in Amazon or Tesla. I'm not in and out. I'm not trying to make a quick buck. I'm not trying to beat the market. Beating the market isn't my goal. My goal is to make as much money as I possibly can in stocks and companies and industries which I think have the best long-term growth potential to return on my investment in ROI. And as such, I'm investing and I'm willing to take the freaking hits when those times inevitably come. That's all there is to it. That's investing. Speculating is like, oh man, I'm going to beat the market. Who freaking cares? I always say this. All right, let's just go back to 2008. S&P 500 is down 37%. If you're at down 33%, you beat the market. Are you happy? You still lost a third of your capital. But I beat the market, Josh. I don't give a rat's butt. You got smoked. You're down a third. All right, so we'll go back to 1998. S&P 500 was up 35%. You were up 38. You beat the market. Wow. Here's a party for you. Happy? Who cares? I mean, I don't get this. I beat the market stuff. Over historically, S&P 500 is up 10%. You're up 10.5%. You beat the market historically. Great. Are you happy? Well, how much time, energy, taxes, all this did you put, fees, trading, did you put into this to try to beat the market? Where if you just would have got the S&P 500, you would have had the market minus your small amount of index fees. Frustrates me no end. Anyway, don't fall for the diversification is for idiots thing. It's cockamamie. It's malarkey, to quote our illustrious presidential candidate, Joe Biden. All right, we'll see you.